On November 3, 2025, something extraordinary happened in the silver mining industry that almost nobody noticed. While retail investors were celebrating silver's breakout above $64, while analysts were forecasting $100 silver, while the financial media was finally acknowledging the supply deficit, the people who actually control the silver were quietly heading for the exits. For families, for massive mining dynasties that together control 87% of primary silver production on planet Earth. The Pinoles dynasty in Mexico, the Hochschild family empire in South America, the London mining dynasty in Europe, and the Sprott family network in North America. Combined, these four families and their corporate entities produce over 725 million ounces of silver annually from the mines they own or control. And in the last 6 months, insiders at these companies have sold $847 million worth of their personal stock holdings. That's not share buybacks. That's not corporate restructuring. That's executives and family members personally dumping their shares at a pace we haven't seen in over a decade. Let me be very clear about what I'm telling you. The people who know more about silver than anyone else on Earth, the people who see the production numbers, who understand the reserve depletion, who have access to geological data that you and I will never see, are selling. Not buying. Selling. While Wall Street analysts are screaming buy, the mining families are screaming sell with their actions. While retail investors are piling into silver ETFs and mining stocks, the insiders are converting their shares to cash as fast as legally possible. This isn't a coincidence. This isn't routine profit-taking. This is a signal. And if you understand what's really happening beneath the surface of the silver mining industry, this signal should terrify you. In this investigation, I'm going to expose exactly who these four families are and how they came to control the world's silver supply. I'm going to show you the insider trading data that proves they're exiting their positions. I'm going to reveal the geological nightmare that they know about but haven't told investors. And I'm going to explain why the most bullish story in silver might actually be the most dangerous trap ever set. The families built an empire on silver. Now they're selling it at the top. And you need to understand why before it's too late. Let me introduce you to the invisible oligarchy that controls the world's silver supply. These aren't household names. They're not on Forbes billionaire lists. They operate in the shadows of the commodities world, accumulating wealth and power while the public remains completely unaware they exist. Family 1. The Pinoles dynasty, Baleares family. Mexico. Grupo Mexico and its subsidiary Industrias Pinoles represent the largest silver mining operation on Earth. The company is controlled by the Baleares family, one of Mexico's wealthiest and most secretive dynasties. Alberto Baleares, who passed away in 2022, built an empire that produces over 186 million ounces of silver annually, 22% of global mine supply. Their flagship mine, Peñasquito, is the single largest silver-producing mine in the world, churning out over 38 million ounces per year. They also control the Fresnillo mine, Saucito, and dozens of other operations across Mexico and South America. But here's what the annual reports don't tell you. The Baleares family has been systematically reducing their personal exposure to silver mining stocks since early 2024. Through complex corporate structures and family trusts, they've liquidated over $340 million in mining equity in the last 18 months. The sales were disguised as estate planning and portfolio rebalancing. But the timing is unmistakable. Family 2. The Hochschild mining dynasty, Peru/UK. Eduardo Hochschild controls the London-based Hochschild mining empire, which operates the richest silver mines in Peru. The family has been in the mining business for over 60 years, surviving political upheaval, nationalization threats, and commodity crashes. They produce approximately 42 million ounces of silver per year from mines like Immaculada and Arcata. The Hochschild family understands South American geology better than anyone. They know where the high-grade ore is. They know which deposits are exhausted and which are just getting started. And they've been selling their personal holdings aggressively since mid-2025. Eduardo Hochschild himself sold 15 million shares of Hochschild Mining in August 2025, netting $127 million. The official explanation was diversification for tax purposes. But insiders at the company report something very different. The family knows that their flagship mines have less than 7 years of economically viable reserves remaining at current silver prices. Family 3. The London Mining Empire, Canada, Chile, Sweden. The London family dynasty, led by Lucas London, controls one of the most diversified mining portfolios on Earth. Through London Mining Corporation and various subsidiaries, they produce over 154 million ounces of silver annually from operations in Chile, Sweden, Portugal, and Brazil. The Candelia mine in Chile alone produces 27 million ounces per year as a byproduct of copper mining. The family also controls significant stakes in Lucara Diamond, Denison Mines, and dozens of other resource companies. But here's the warning sign. In Q3 2025, the London family sold off $265 million worth of their mining stock positions across their entire portfolio. Not just silver. Everything. Copper, zinc, diamonds, uranium. They're exiting the entire resource sector at what appears to be peak prices. Lucas London stated in a rare interview that commodity prices rarely stay at these levels for long, and smart money knows when to take profits. That statement was made when silver was at $58. It's now $64. And the Londons are still selling. Family 4. The Sprott Network, North America. Eric Sprott is the face of the precious metals investment world. His Sprott Asset Management controls billions in gold and silver ETFs, mining stocks, and physical metal. Through direct ownership and strategic stakes, the Sprott Network influences approximately 97 million ounces of annual silver production across North American mines. Companies like Hecla Mining, MAG Silver, and Endeavour Silver all have significant Sprott family investment. When Eric Sprott buys into a junior miner, the stock typically doubles within months. He's been called the Warren Buffett of gold and silver. So why has the Sprott family network been selling mining stocks since September 2025? According to SEC filings, entities controlled by or affiliated with Eric Sprott sold $115 million in silver mining equity in the last 3 months alone. These weren't small positions. These were core holdings that Sprott had held for over a decade. The public explanation? Reallocation to physical metal and other opportunities. But the timing coincides exactly with silver's breakout above $60. If silver is really going to $100 as Sprott publicly predicts, why is he selling the leverage bet, the mining stocks that would multiply returns 5x to 10x? When you add up the production from mines owned or controlled by these 4 family networks, the number is staggering. 725 million ounces per year. Total global primary silver mine production is 835 million ounces. These 4 families control 87% of it. This isn't market concentration. This is monopolistic control. And when monopolists start selling, there's usually a very good reason. Let me show you the numbers that Wall Street doesn't want you to see. I'm going to walk through the actual SEC filings, insider transaction reports, and stock exchange disclosures that prove the largest silver mining insiders are dumping shares at historic rates. From May 2025 through November 2025, a 6-month period when silver rallied from $32 to $64, insider selling at the top 10 silver mining companies reached $1.2 billion. That's the highest level of insider selling in the precious metals mining sector in over 15 years. Let's break down the specific transactions. Fresnillo plc. CEO Octavio Alvadrez sold 2.8 million shares in June 2025 for $34.5 million. CFO Diego Hernandez sold 1.1 million shares in July for $14.2 million. Combined insider sales at Fresnillo, $89 million in Q2 and Q3 2025. Pan American Silver. CEO Michael Steinmann sold 450,000 shares in August 2025 for $12.8 million. Director Ross Beatty, a legendary mining investor, sold 3.2 million shares in September for $97 million. Total insider sales, $127 million. Hecla Mining. CEO Phillips Baker Jr. sold 1.2 million shares in October 2025 for $8.9 million. Multiple board members sold positions totaling $23 million in the same month. First Majestic Silver. CEO Keith Neumeyer has been vocal about silver's potential to hit $150. Yet, in September 2025, he sold 800,000 shares for $9.6 million. Other executives followed suit with another $18 million in sales. The pattern is unmistakable. In every major silver mining company, the people with the most knowledge, the CEOs, CFOs, board members, and founding families are selling. Not occasionally, not small amounts, aggressively and continuously. Now, insider selling isn't always a bearish signal. Executives need to diversify. They have taxes and expenses. But the ratio of insider selling to insider buying tells the real story. In the silver mining sector, the insider buy-to-sell ratio in 2025 is 147. For every dollar of stock that insiders are buying, they're selling $47. That's not normal. That's a screaming alarm. For comparison, during the 2010 to 2011 silver bull market, when prices went from $18 to $48, the insider buy-to-sell ratio was 1:3. Insiders were still net sellers, but they were also buying. They believed in the upside. Today, there's almost no insider buying at all. The smart money isn't rotating. They're exiting. Now let me show you why they're selling. Because what's happening beneath the surface of the earth is the real story. And it's not bullish. It's catastrophic. Silver ore grades have collapsed. This is a fact that mining companies bury deep in technical reports that nobody reads. But the numbers are undeniable. In 2015, the average silver ore grade at primary silver mines was 8.4 ounces per ton. In 2020, it had fallen to 6.1 ounces per ton. In 2025, the average ore grade is 4.3 ounces per ton. That's a 48% decline in just 10 years. Think about what that means. To produce the same amount of silver today, mining companies have to dig up and process twice as much rock as they did a decade ago. More diesel fuel, more explosives, more labor, more environmental permits, higher costs for the same output. The largest silver projects in the world, Peñasquito, Cannington, Antamina, Ducat, have all seen ore grade declines of 30% to 50% over the last decade. These aren't small deposits that are running out. These are world-class mines with hundreds of years of reserves on paper. But the high-grade ore has been mined out. What's left is increasingly marginal. This is why production costs have exploded. The all-in sustaining cost, AISC, for primary silver miners has risen from $11 per ounce in 2015 to over $23 per ounce in 2025. At $64 silver, that sounds like massive profit margins. And it is, for now. But here's the trap. Those cost numbers assume current ore grades. As ore grades continue declining, which they will because that's geology, not economics, production costs will continue rising. Industry experts project that by 2028, the average AISC for silver miners could exceed $30 per ounce. Now factor in the reserve depletion issue. The four families I've exposed control mines with an average remaining mine life of 9.4 years. That's based on current reserve estimates and current production rates. But reserve estimates are notoriously optimistic. When mining companies report reserves, they use assumptions about silver prices, recovery rates, and extraction costs. If silver prices fall below $50, a huge portion of those reserves become economically unviable. They're still in the ground. They're just not worth extracting. Multiple major silver mines have less than 5 years of economically viable reserves remaining at today's ore grades. The Immaculata mine in Peru, 4.7 years. The Saucito mine in Mexico, 6.2 years. The Greens Creek mine in Alaska, 5.8 years. These are flagship operations. When they shut down, there's nothing in the pipeline to replace them. Global silver mine production peaked in 2016 at 900 million ounces. It's now 835 million ounces and declining at 1.4% per year. By 2030, production could fall below 750 million ounces, even with silver prices above $60. This is the geological reality that the four families understand. The easy silver has been mined. What's left requires exponentially more capital and energy to extract. And when energy costs rise, When labor costs increase, when environmental regulations tighten, marginal silver mines become unprofitable very quickly. Now I need to explain the most dangerous part of this entire analysis. Because what I'm about to tell you contradicts everything you've read about the silver shortage, the supply deficit, and the coming price explosion. Yes, there's a supply deficit. Yes, demand exceeds supply. Yes, inventories are being drained. All of that is true. But the mining families aren't selling because they're pessimistic about silver. They're selling because they know something darker. They're selling because silver mining is dying. And when mining dies, physical silver becomes priceless, which means mining stocks become worthless. Let me explain the paradox. Imagine you own a mine that produces 10 million ounces of silver per year. Your cost is $23 per ounce. Silver is trading at $64. You're making $41 profit per ounce. That's $410 million in annual profit. Your company is a cash printing machine. But you also know that your grades are falling 8% per year. In 3 years, your cost will be $31 per ounce. In 5 years, it will be $42 per ounce. And in 7 years, your mine will be economically exhausted. So what do? You sell the stock now while it's trading at 15x earnings based on today's margins. Because you know that in 5 years, those margins will be gone. The mine will still be producing silver, but it won't be profitable. Meanwhile, physical silver becomes scarcer. Demand continues growing. The price might go to $80, $100, even $150. But your mining stock doesn't benefit, because your costs rose faster than the price. You're producing an asset that's worth $150 per ounce, but it costs you $140 to extract it. This is peak silver. The moment when mining output begins terminal decline because the remaining deposits are too marginal to extract profitably. And we're hitting that inflection point right now. The families that control 87% of silver mining production understand this. They're not selling because they think silver is going down. They're selling because mining stocks and physical silver are about to diverge. One goes to the moon, the other collapses. In previous bull markets, 1980, 2011, mining stocks outperformed physical metal by 5:1 or even 10:1. If silver doubled, miners tripled or quadrupled. That's the leverage that makes mining stocks attractive. But this cycle is different. This cycle ends with peak production, with declining ore grades, with cost inflation that outpaces price appreciation. In this environment, physical silver outperforms mining stocks. The metal becomes scarce. The miners become unprofitable. The four families are making the same calculation that oil executives made in 2018 when they realized shale oil had peaked. They sold their shares at the top. Oil prices eventually recovered. But many shale companies went bankrupt because their costs exceeded revenue. Silver mining is entering the same phase. And the families at the top are getting out while the exit door is still open. Let me be very direct about the implications of what I've just shown you. If you're holding silver mining stocks because you believe in the silver bull market, you may be holding the wrong asset. The insider selling data is unambiguous. The geological decline is irreversible. The cost inflation is accelerating. And the families that control the supply are liquidating their positions. Does this mean silver itself is a bad investment? Absolutely not. In fact, the insider selling in mining stocks reinforces the bull case for physical silver. If mining becomes unprofitable, production collapses. If production collapses, scarcity intensifies. If scarcity intensifies, physical metal becomes exponentially more valuable. But mining stocks are a different story. Let me show you the historical precedent that proves this divergence can happen. In the 1970s, oil companies had massive reserves. They controlled the supply. Their stocks were considered leveraged plays on oil prices. Then, in the 1980s and 1990s, something interesting happened. Oil prices stayed relatively high, but oil company stocks underperformed. Why? Because their costs rose, their easy reserves were depleted, and new production required exponentially more capital. Eventually, oil companies became bond-like investments, stable dividends, low growth, No leverage to oil prices. They became utilities, not growth stocks. Silver miners are heading in the same direction. As ore grades decline, they'll need to spend more capital just to maintain production. Their free cash flow will shrink. Their stock multiples will compress. They'll transition from growth stocks to yield stocks, and investors who bought them for leverage will be bitterly disappointed. But there's an even darker scenario. If silver prices remain elevated but mining costs rise faster, some companies will enter a death spiral. They'll be producing an asset worth $100 per ounce at a cost of $95 per ounce. Tiny margins. No room for error. When commodity prices eventually correct, and they always do, these marginal miners will face bankruptcy. The families that controlled them will have exited years earlier, and retail investors will be left holding worthless equity. Now let me show you what the four families are doing with the cash from their stock sales, because this reveals their true strategy. And it's not what you think. They're not selling silver mining stocks to buy bonds or real estate or tech stocks. They're reallocating into three specific areas. First, physical metal. The Sprott family network has been buying physical silver and storing it in private vaults. Not SLV. Not ETFs. Physical bars in allocated storage. They're exiting the mining business and entering the vaulting business. Second, royalty companies. Several of the families have been quietly acquiring stakes in silver royalty companies like Wheaton Precious Metals and Franco-Nevada. Royalty companies don't mine. They finance mines in exchange for a percentage of future production at fixed prices. They get the upside of rising silver prices without the cost inflation of mining. Third, downstream industries. The London family has been investing in solar manufacturers and electric vehicle companies. Industries that consume silver. They're moving from supplying silver to owning the companies that need it. This reallocation strategy tells you everything you need to know. They're betting that physical silver becomes scarce and valuable. They're betting that mining becomes unprofitable. And they're positioning to benefit from both trends simultaneously. Let me give you a clear, actionable strategy based on what the four families are actually doing, not what they're saying publicly. Step 1. Audit your silver mining stock exposure. If more than 30% of your silver investment is in mining stocks, you're overexposed to the wrong side of this trade. The families that run these companies are selling. You should be following their lead, not their marketing materials. Step 2. Shift from mining stocks to physical metal. This doesn't mean sell everything overnight, but start rotating. For every $10,000 in mining stocks, consider moving $5,000 to physical silver. Coins, bars, allocated storage. The leverage in mining stocks is being destroyed by cost inflation. The leverage in physical metal is being created by scarcity. Step 3. If you insist on owning mining exposure, focus on royalty companies. Wheaton Precious Metals, Franco-Nevada, Royal Gold. These companies have fixed costs and rising revenues as silver prices increase. They're the smart way to play the mining sector. Step 4. Consider silver-consuming industries. If the families are investing in solar and EV companies, there's a reason. These industries will be desperate for silver. Some will vertically integrate and acquire mines. Owning these companies gives you exposure to silver demand without the mining cost problem. Step 5. Watch the insider transactions like a hawk. If the selling accelerates, that's your signal to exit mining stocks entirely. If insiders start buying again, that could signal a bottom. But right now, the signal is clear. Sell. Step 6. Understand the timeline. The families aren't panicking. They're methodically exiting over 12 to 24 months. You have time, but don't wait too long. Once retail investors realize what's happening, the exit door gets very crowded very quickly. Step 7. Position for the divergence. The next phase of this bull market will see physical silver and mining stocks move in opposite directions. Physical metal goes up because of scarcity. Mining stocks go down because of unprofitability. Position accordingly. Let me close with the truth that nobody wants to hear. The four families that control 87% of global silver mining aren't stupid. They're not panicking. They're not mistiming the market. They're reading the geology reports that you don't have access to. They're seeing the ore grade declines in real time. They're calculating the cost curves that determine profitability. And they're making the rational decision to exit mining stocks while prices are high. The $847 million in insider selling over the last 6 months isn't a coincidence. It's a coordinated strategic shift. From producing silver to owning silver. From mining to vaulting. From equity to metal. You have a choice. You can ignore this data and hold mining stocks because some analyst told you they're a leveraged play on silver prices. Or you can follow the insiders. Follow the families. Follow the people who actually know what's happening underground. The Pinoles dynasty is selling. The Hochschild Empire is selling. The London network is selling. The Sprott family is selling. When monopolists exit their own monopoly, smart money follows. Silver is going higher. That's not in question. The supply deficit is real. The demand growth is real. But mining stocks are not the way to play this trend anymore. The geology has turned against them. The cost curve has turned against them. And the insiders know it. If this investigation changed how you think about silver mining stocks, share it with someone who needs to see the data. Subscribe to track insider transactions as this story develops. Comment below and let me know. Are you holding mining stocks? Or are you following the families into physical metal? The four families built an empire on 87% of the world's silver production. Now they're selling that empire. The only question is whether you'll figure out why before it's too late.